Friday's strong US jobs data mean a rate rise from the Federal Reserve later this month is now all but assured. Yet emerging markets in Asia were generally higher on Monday, which might not seem the most natural reaction for an event expected to put borrowers in those countries under pressure and to drain liquidity from Asian markets. The answer could lie in the dollar. The US currency has been rising steadily in anticipation of higher interest rates, helped by the fact that other major economies, namely the Eurozone, China and Japan, are still easing policy. This chart shows what normally happens to the dollar around the time the Fed begins a rate-rising cycle. I'm including 2013's taper tantrum, when the Fed signaled it would begin scaling back its asset purchases. The general direction is clear. Investors have tended in market speak to buy the dollar on the rumour and sell, or at best hold it, on the fact. Of course, the dollar faced a different set of circumstances each time, as it does now as well. For one, normally Fed tightening coincides with rising global growth. That isn't the case this time. Another difference is the unprecedented degree of monetary policy divergence between the world's major economies. But there has been a general pattern, and assuming that holds, it could again provide some relief for emerging markets. Dollar strength is the single biggest contributor to negative emerging market returns this year, according to Credit Suisse. Besides the impact of a strong greenback in raising import prices and weakening economic growth, the poor dollar returns deter international investors. The situation is so extreme that for the benchmark MSCI Emerging Market Index, the gap between total returns in dollars and in local currencies is at its widest since the Asian financial crisis in the 1990s. The dollar isn't the only cause of emerging market weakness. Economic growth has slowed and profit margins are under pressure, with little respite in sight. 2016 isn't likely to be a banner year for the asset class, full stop. But if the dollar does roughly what it has done each time at this point in the cycle in the past 30 years, then its strength will be one less thing to weigh on emerging markets.